significant drop overall in the last couple of years in housing affordability.
New numbers are offering an important snapshot of the housing market today. So the good news, falling mortgage rates are helping to boost housing affordability.
While national headlines promise a soft landing, seasoned investors are quietly bailing out of Ohio's housing markets. The media keeps watching coastal bubbles, but the real correction is brewing right here, in Ohio's forgotten industrial cities, where demand is drying up and populations are vanishing. This isn't about growth anymore, it's about survival. Institutional money is pulling out before the collapse hits the front pages. In this breakdown, we're counting down the 10 Ohio real estate markets on the brink of devastation, and showing where the cracks are spreading fastest. Number 10. Ashland. Tucked between Cleveland and Columbus sits a mid-sized market that most people have never heard of. This city of about 20,000 people looks quiet on the surface. Too quiet. The kind of quiet that comes before a storm, not after one. Recent data from multiple sources shows this area experienced decreases in both the number of homes sold and average sale prices. That's the dreaded double whammy: less demand, lower prices. The demographics here tell a troubling story. The median age keeps climbing. Young professionals aren't moving in. Families are leaving for Columbus or Cleveland, where the jobs actually are. The local economy relies heavily on manufacturing and agriculture, sectors that haven't provided wage growth that keeps housing markets healthy. When your biggest employers are struggling to compete globally, your housing market feels it immediately. Here's the real problem. Inventory is rising while demand is falling. Homes sit on the market longer. Sellers get anxious. And when sellers get anxious in a market like this, price cuts follow. One analysis specifically noted this market among softer markets showing slower growth. The forecast through September 2025, minimal price appreciation, maybe 2.5% if you're lucky. The local driver is simple. There's no economic catalyst. No major employer moving in, no infrastructure project, no reason for people under 40 to stay or move here. And in real estate, demographics are destiny. When the working age population shrinks, housing demand evaporates. This market isn't devastated yet, but the foundation is cracking. Give it 2 to 3 years, and you'll see the real damage. But here's the kicker. This is just the beginning. Wait until you see what's happening in our Northeast. Number 9. Mansfield. We're heading to a city of about 46,000 people that embodies everything wrong with Ohio's Rust Belt economy. This place used to manufacture everything: appliances, auto parts, steel products. Now it manufactures desperation. The unemployment rate here consistently runs above state averages. The poverty rate hovers around 18%. And the housing market? It's a disaster waiting to happen. Home values in this market have been essentially flat for years. We're not talking about explosive growth that needs to cool off. We're talking about stagnation, the kind that indicates fundamental economic weakness. The median home value sits around $130,000, which sounds affordable until you realize wages here haven't kept pace with even that low number. The local driver is brain drain combined with industrial decline. The city's largest employers have been downsizing for decades. Companies that remain offer wages that can't compete with Columbus, which is only 90 minutes south. So what happens? Young college graduates leave. Skilled workers leave. What's left is an aging population with fixed incomes and retirees on Social Security. That demographic doesn't drive housing demand. It suppresses it. Here's what really worries experts. The inventory to sales ratio is creeping up. More homes are listed than can be absorbed by the local market. That creates downward pressure on prices that sellers can't escape. Some properties sit for months, even at reduced prices. The average days on market keeps extending. And when homes sit that long in a market this small, panic sets in. The punchline? This market has been declining slowly for so long that most people don't even notice anymore. It's like watching ice melt. But make no mistake, the devastation is already here. It's just happening in slow motion. Before we break into the next market, make sure you hit subscribe and turn on notifications. We track real estate trends the mainstream media won't touch. from hidden collapses to quiet investor moves. Number 8. Portsmouth. This city sits on the Ohio River, and it's drowning. With a population of about 20,000, this place used to be a thriving river port and industrial center. Today, it's ground zero for Ohio's economic and social crisis. The opioid epidemic hit this region harder than almost anywhere in America. The population has been declining for decades, and the housing market reflects every bit of that pain. Multiple housing market analyses specifically flag this area as experiencing decreased average sale prices alongside falling sales volume. That's the death spiral of real estate markets. When both price and volume fall simultaneously, it indicates fundamental demand destruction. People aren't just choosing to wait, they're choosing to leave entirely. The median home price has dropped below $90,000 in some neighborhoods. That's not affordability, that's abandonment. The local driver here is multi-layered tragedy. First, the economic base collapsed when manufacturing left. Then, the opioid crisis devastated families and destroyed neighborhoods. Property crime rates spiked. School quality declined as the tax base eroded. Now you have a vicious cycle. Bad schools drive out families with kids, which reduces the tax base further, which makes schools worse, which drives out more families. Real estate investors who came in 10 years ago thinking they'd found a bargain market have been bleeding money. Rental properties sit vacant for months. When they do rent, tenant quality is poor and eviction rates are astronomical. Property damage is common. The cost of maintaining rental properties exceeds the rental income in many cases. That's why you see so many boarded up houses throughout the city. The forecast here isn't just bad, it's catastrophic. Unless there's massive federal intervention, this market will continue contracting for the nest decade. Home values will keep falling, and the people left behind will see their largest asset become worthless. Number 7. Steubenville. Here's a cautionary tale about what happens when an entire city's economy vanishes. Welcome to a place where 1 in 4 residents, 25.68% to be exact, lives below the poverty line. That's more than double the national average. The median household income is $39,000 compared to $74,000 nationally. And the population? It's declined from over 35,000 in the 70s to just 18,000 today. Half the people left. PBS News did an extensive report calling this city a symbol of communities left behind in the modern American economy. Steel mills that once employed thousands shut down in the 80s after NAFTA and Asian competition destroyed domestic steel. Generations of families saw their livelihoods disappear overnight. The median age is 36, but it's aging rapidly as young people flee. What does this mean for real estate? Total devastation. Home values here are among the lowest in Ohio. Many properties sell for under $60,000. But even at those basement prices, homes sit for months. Why? Because even people who can afford a $50,000 house don't want to live in a city with no jobs, high poverty, and limited services. The local driver is economic extinction. There is no growth industry here. No tech sector, no healthcare boom, no manufacturing renaissance. A steelworkers union rep who's been working in the region for 40 years told PBS he doesn't think he'll be around to see the heyday again. That's not pessimism. That's reality. Real estate in markets like this isn't an investment. It's a trap. You buy low, but you can never sell high because there's no one to sell to. Property taxes keep rising as the city desperately tries to maintain services with a shrinking tax base. Number 6. Lima. We're heading to Northwest Ohio, to a city of about 36,000 that ranks among Ohio's legacy metros. This is a perfect example of a market where ultra-low prices mask deeper problems. The median home price here hovers around $120,000, cheap by any measure. But there's a reason it's cheap, and that reason should terrify anyone thinking about buying property here. The city has been losing population for decades. What was once a thriving industrial center built around railroads and manufacturing has become another casualty of globalization and automation. The jobs that remain pay wages well below state and national averages. The result? A housing market with no upward pressure. Prices stay low not because of abundant supply, but because of anemic demand. Recent forecasts show this market among those expected to see minimal price growth, perhaps 1 to 2% annually if conditions hold. But conditions rarely hold in economically distressed markets. Any national recession, any spike in unemployment, any factory closure could push this market into negative territory. And once prices start falling in a place like this, they tend to fall for years because there's no floor. The local driver is the same story. Industrial decline, population loss, aging demographics. But here's what makes this market particularly vulnerable. It's geographically isolated. It's not a suburb of a thriving metro. It's not on a major interstate corridor. It's not home to a large university. It's just a standalone small city in the middle of farmland with a declining economic base and no clear path to renewal. The investor community has completely written off markets like this. You won't find institutional capital flowing here. What you'll find is neglect. Properties that don't get maintained because owners can't afford it or don't care. Neighborhood by neighborhood, this city is slowly deteriorating. Number 5, Warren. This city's name has become synonymous with Rust Belt decay. Part of the Youngstown-Warren metro area, this city of about 39,000 people has seen its population cut in half since the 70s. Half. The steel mills that employed tens of thousands are gone, the auto plants are gone. What remains is an economy built on low-wage service jobs, healthcare for an aging population, and government services. The housing market here tells a story of managed decline. According to recent data, the Youngstown-Warren-Boardman metro area saw some price growth in early 2025, up 13.6% according to one national report. But don't let that number fool you. When you're starting from a median price around $110,000, a 13% increase just means you're going from incredibly cheap to slightly less cheap. The local driver here is what economists call a poverty trap. The city can't attract new businesses because the workforce is undereducated and aging. It can't improve schools because the tax base is too small. Young people can't find good jobs, so they leave, which further erodes the tax base. It's a self-reinforcing cycle of decline that's been running for 40 years and shows no signs of stopping. Real estate here is essentially a value trap for investors. Properties are so cheap that out-of-state investors buy them thinking they'll generate rental income. But tenant quality is poor, eviction rates are high, property damage is common, and property taxes keep rising to fund underfunded city services. Many investors end up walking away from properties, letting them go to tax sale because it's cheaper than continuing to own them. The forecast here is more of the same. Slow, grinding decline punctuated by occasional statistical blips. Property values will remain suppressed, and anyone who buys real estate here better accept minimal returns. Number 4, Springfield. This city has been making headlines for all the wrong reasons. With a population of about 58,000 people, this place has become a flashpoint in national debates about immigration, economic policy, and urban decline. NPR did a feature calling it a shrinking city facing a tough economic future. That was back in 2016. Guess what? It's 2025, and things haven't improved. The city has transitioned away from manufacturing toward lower-paying service sector jobs. For many residents, a middle-class life is completely out of reach. The median household income is well below state and national averages. The poverty rate sits above 20%. And the housing market? It's stagnant at best, declining at worst. The median home value hovers around $115,000. Affordable, sure, but affordable for a reason. The local driver here is what happens when you lose your economic base and can't replace it with anything comparable. The factories that paid middle-class wages are gone. What replaced them are retail jobs, fast food jobs, warehouse jobs, positions that pay $12 to $15 an hour with no benefits. You can't sustain a housing market on wages like that. Recent data shows this market among Ohio's softer markets experiencing slower growth or even some softening. Translation: prices aren't climbing, and in some neighborhoods, they're actively falling. Homes sit on the market longer than state averages. Price reductions are common, and the demographic trend is terrible. Young families are leaving for Columbus or Dayton where wages are higher and opportunities are better. Here's what really devastates markets like this: the tax base erosion. As property values stagnate, the city collects less revenue. But fixed costs don't decline, so the city raises property tax rates. Now, you're paying higher taxes on a property worth less than when you bought it. That's the definition of a wealth destroyer. Number 3. Middletown. This city sits between Cincinnati and Dayton, a city of about 48,000 that was supposed to benefit from its geographic position. It hasn't. This is another legacy city that lost its manufacturing base and never recovered. The city's economic struggles were famously documented in the book and movie Hillbilly Elegy, a story about poverty, addiction, and the decline of the American working class. The housing market reflects every bit of that struggle. Median home values here sit around $130,000. Days on market are extending. Inventory is growing while sales volume remains flat or declining. The percentage of homes selling above list price has dropped. More sellers are cutting prices. These are all indicators of a market under stress, a market where sellers have lost pricing power and buyers have all the leverage. The local driver is geographic curse disguised as geographic blessing. Yes, the city sits between two larger metros, but that also means anyone with ambition or education simply commutes to Cincinnati or Dayton for work, then moves there when they can afford to. The city becomes a place you're from, not a place you aspire to live. That's poison for real estate values. The demographic trend here is particularly worrying. The population is aging rapidly. The percentage of residents over 65 is climbing, while the percentage under 35 is dropping. That means fewer first-time homebuyers, fewer families upgrading, fewer people in their peak earning and spending years. What you're left with is retirees on fixed incomes and younger people stuck in low-wage jobs. Neither group drives housing appreciation. The forecast is grim. Barring some major economic intervention, a large employer moving in, a major university expansion, federal infrastructure spending, this market will continue treading water at best, declining at worst. Property values will stay suppressed. The housing stock will age without adequate investment and renovation. Number 2, Youngstown. Welcome to the poster child for Rust Belt decline. This city's metro area population has collapsed from 163,000 in 1980 to just 114,000 today. That's a loss of 49,000 people, 30% of the population gone. The steel mills that were the city's lifeblood closed in the 80s. Unemployment spiked, families fled, and the housing market has never recovered. Today, the median home price in the city proper is around $113,000, according to Redfin data from July 2025, actually down 3% year over year despite the broader Ohio market rising. Zillow shows some areas with median values as low as $51,000. That's not a home price, that's a warning. What's happening here is what economists call urban contraction. The city is literally shrinking. Homes are abandoned, entire blocks sit empty. The city has demolished thousands of vacant structures, but more keep falling into disrepair. The remaining population is older, poorer, and less educated than state averages. Median household income is well below $40,000. The poverty rate exceeds 25% in many neighborhoods. The local driver is complete economic collapse. When the steel industry died, nothing replaced it. Some service jobs, some healthcare positions, some government work, but nothing that provides middle-class wages for thousands of people. Recent employment forecasts show modest growth, but starting from such a devastated base that even 3% growth means almost nothing. Here's what devastates long-term property owners. They bought homes expecting normal appreciation. Instead, they watched their property values stagnate for 20 years, then decline. They paid mortgages on homes now worth less than they paid. Recent reports show that 46% of residents searching for homes online are looking to leave the metro area. When even current residents are trying to escape, there's no floor for property values. Number 1, Lorain County. The top spot doesn't belong to a single city. It's an entire county that's experiencing something experts didn't predict: rapid market destabilization despite proximity to Cleveland. Lorain County sits right on Lake Erie, includes cities like Lorain, Elyria, and Oberlin, and should theoretically benefit from Cleveland's economic revival. But recent data shows something alarming is happening here. According to comprehensive Northeast Ohio housing market analysis from August 2025, Lorain County saw the biggest price increases in the region, up 17.7% to a median of $263,300. That sounds great until you see the other number. Homes are taking 51.9% longer to sell than last year. That's not healthy appreciation. That's a market where sellers desperately hold out for high prices while buyers refuse to pay them. What's happening here is what economists call a price-volume divergence. Sellers think they're in a hot market because Columbus and Cleveland are booming. They list high. But buyers look at the actual local economy, manufacturing decline, aging demographics, limited job growth, and refuse to pay those prices. So homes sit, and eventually, sellers will blink. When they do, prices will fall fast. The county includes several legacy cities flagged in that comprehensive study we mentioned. Cities with declining populations, aging residents, and reduced economic vitality. Yes, there's Oberlin College, which provides some stability. But one college doesn't offset the structural decline happening across the broader county. Here's what makes this devastating. It's a market where participants haven't yet realized they're in trouble. People in Steubenville and Youngstown know their markets are devastated. But people here still think they're riding Cleveland's wave. They're not. They're on the edge of a cliff, and the first ones who realize it will trigger a stampede for the exits. So there it is, 10 Ohio markets on the edge of collapse. What you've seen isn't just a housing story, it's a warning about what happens when population decline, lost industry, and false optimism collide. The devastation here could be a preview for dozens of mid-sized cities across America. If you found this breakdown eye-opening, subscribe for more data-driven deep dives. We'll be covering the next wave of markets showing the same early warning signs. Until then, stay smart, stay skeptical, and watch where the cracks form next.